Is the crypto market setting up for an explosion or a trap? The signals are all over the place. On one hand, the SEC just gave a huge green light for Ethereum staking, and Tom Lee is calling ETH the single biggest trade for the next decade. We're also seeing entire countries like Brazil get serious about putting Bitcoin in their reserves. The market even shrugged off an $8 billion sale from a Satoshi-era wallet, showing just how much institutional money is pouring in. But it's not all good news. Some analysts are turning bearish for the short term, pointing to a likely drop below $112,000 to wipe out leveraged traders. While Bitcoin is absorbing all the new cash, many altcoins are getting left in the dust. So, who do you believe? In the latest video from Altcoin Daily, the channel discusses some massive news for the crypto market. The big story is the SEC's declaration that liquid staking activities are not considered securities. This is a huge development because it's seen as the final piece of the puzzle for getting staking approved in spot Ethereum ETFs. This news is contributing to a sharp drop in Ethereum's supply on exchanges, which is now at its lowest point in years, setting the stage for a potential supply shock. The video also features a spirited debate from the Coin Stories podcast between Tom Lee and Natalie Brunell. Tom Lee makes a bold claim, stating that Ethereum is having its 2017 moment and believes it's the single biggest macro trade for the next decade, even more so than Bitcoin, because Wall Street is finally getting serious about tokenization on its network. On the other hand, the discussion touches on Bitcoin's strong outlook. Tom Lee is also extremely positive on Bitcoin, suggesting it could eventually replace gold and reach over $1 million. For the end of this year, he sees Bitcoin possibly hitting $200,000 to $250,000, while the video's host has a base case of $150,000. The overall message is that the market is in a major reaccumulation zone, and any dip in August should be viewed as a buying opportunity before a very strong end to the year. The excitement in this video is pretty reflective of the current market mood. The SEC's classification of liquid staking is a genuinely significant event, removing a major cloud of uncertainty that has hung over Ethereum and similar platforms. The segment with Tom Lee is the most interesting part. His argument for Ethereum as the next decade's trade because of tokenization is a strong one. We are seeing major financial institutions experiment with putting real-world assets on-chain. However, the counter-arguments about centralization risk are just as valid and represent the core philosophical divide in crypto. The Bitcoin price predictions, while high, aren't out of line with what many analysts are projecting given the success of the spot ETFs and the continued institutional buying reported by firms like Bitwise. It feels like the market is pricing in a perfect storm of positive factors, and the buy-the-dip narrative is getting louder. In the latest video from the Crypto Rover channel, the host reveals he has just entered a $5 million long position on Bitcoin. He's feeling confident because of a few clear signs he's seeing on the charts. First, an inverse head and shoulders pattern has formed, with Bitcoin's price now retesting a former resistance level as new support. He also points to market seasonality, suggesting we have about 2 months left in the current bull market, a period that historically sees strong price action. It's always interesting to see a trader lay out their thesis with this much conviction. The technical patterns he's watching, like the inverse head and shoulders, are classic signals that many traders follow, so it makes sense to build a strategy around them. His price target of $137,000 is definitely ambitious, but those kinds of calls are what bull markets are made of. I think his point about Ethereum is particularly relevant. The ETH-Bitcoin pair has been stuck for a while, and a lot of people are waiting to see if it can finally break its major resistance. If it does, it could certainly spark the alt season everyone talks about. However, the market feels like it's walking a tightrope right now, with a lot of influence coming from wider economic news. While the charts might be showing bullish signs, unexpected inflation data or policy changes could easily shift the mood, so it's a pretty gutsy move. In the latest video from the Crypto Tips channel, they explain the serious risks of altcoin investing, noting that over 75% of the 5,000 plus coins launched in the 2021 bull run failed. The video offers a practical guide to help you find projects with substance and avoid the ones built on hype. The first step is to research the team's background using their website, LinkedIn, and Crunchbase to verify their experience. Next, you should check for consistent development activity on the project's GitHub or by using a site like cryptomiso.com. A lack of updates is a bad sign. This advice feels more important than ever. The current market is flooded with new projects, and it's incredibly easy to get caught up in a story without checking the facts. The video's focus on data-driven tools like Dune Analytics and DeFi Llama is spot on. These have become the new standard for serious investors. In my view, what separates successful investors from the rest isn't just knowing about these tools, but knowing how to connect the dots between them. A strong team means nothing if there's no development activity, and great tech is useless without a fair token distribution and real user adoption. This kind of thorough check is what can make a real difference. In the latest video from Lark Davis, he kicks things off by pointing out a massive trend. Entire countries are seriously looking at adding Bitcoin to their national reserves. He mentions an Italian MP calling it inevitable, Indonesia's vice president's office considering it, and Brazil scheduling its first hearing on a Bitcoin reserve for August 20th. This isn't just small nations anymore. Major economies are joining the conversation, which he believes signals a huge financial revolution. The idea of nations creating strategic Bitcoin reserves is getting very real. Brazil moving forward with hearings is a concrete step, not just talk. It feels like the financial game is changing from the top down. While retail traders are focused on daily charts and meme coins, governments and massive corporations are making multi-decade plays. The corporate buying of Ethereum is especially interesting. When you hear that companies snapped up 1.5% of the supply so quickly, it shows a calculated, aggressive strategy to own a piece of the future digital economy. It's a very different kind of buying pressure than we saw in previous cycles. This institutional and sovereign-level interest is building a foundation for the market that's far stronger than just hype. In the latest video from the Ben Cowan channel, the discussion centers on why this crypto cycle feels so different from the 2020 to 2021 run. Cowan points to the Advanced Decline Index, ADI, for the top 100 coins, which measures the number of advancing coins minus the declining ones. He shows that while the total crypto market cap has been rising, the ADI has been consistently going down. I think Cowan's analysis here really hits the nail on the head. It's a data-driven way of explaining the general feeling of frustration among many altcoin holders. The market has fundamentally changed with the arrival of institutional players via Bitcoin ETFs. That new, significant capital is flowing almost exclusively into Bitcoin, sucking the air out of the room for most other assets. It's no longer a retail-driven market where hype can lift all boats equally. What Cowan describes as a rotation feels more like a desperate fight for leftover liquidity. It seems the days of a tide that raises all ships are on hold, replaced by a more mature, top-heavy market where Bitcoin acts as the center of gravity. In the latest video from the Coin Bureau channel, Guy explains how using AI like ChatGPT might be making us dumber, and he's got the science to back it up. A recent MIT study took a look at people's brains while they used ChatGPT for writing. The scans showed that the AI users had way less brain activity. Their memory, creative thinking, and focus all took a nosedive. Researchers call it cognitive debt. You get the task done fast, but you're not actually building any thinking skills for the future. The study also found that essays written with AI all looked boringly similar and soulless. This video touches on a fear that feels both old and new. We've always used tools to offload mental work, from abacuses to smartphones. However, the concern around generative AI seems different. It's not just offloading a calculation or a memory, it's offloading the entire process of synthesis and creation. The homogenization of thought is a genuine risk. If a generation learns to write and think through the lens of a few large language models, we could see a serious drop in original ideas and critical perspectives. It feels less like using a calculator and more like letting someone else lift the weights for you at the gym. You're in the building, but you're not getting any stronger. The real discussion shouldn't be about banning AI, but about developing the discipline to use it as a sparring partner rather than a replacement for our own minds. In the latest video from Crypto's Russ, the host discusses the recent stability of the crypto market despite some selling pressure from Wall Street. He explains that while Bitcoin saw a minor dip from around $115,000 to $114,000, the real story is the market's incredible strength. It was just confirmed that Galaxy Digital helped facilitate the sale of 80,000 Bitcoin from a holder dating back to the Satoshi-era. This sale, worth over $8 billion, happened a couple of weeks ago and was absorbed by the market with barely a ripple. It's my view that the market's reaction to this 80,000 Bitcoin sale is a significant indicator of its growing maturity. In past cycles, the mere rumor of such a large amount of coins moving would have triggered a panic selling cascade. The fact that the market absorbed an $8 billion sale without a major downturn shows that the demand side, largely fueled by institutional spot ETF inflows, is far more robust than ever before. This resilience is likely creating a feedback loop. As large sales fail to crash the price, more conservative institutional players may feel increasingly confident to enter the market, further strengthening the support floor for Bitcoin. This is a far cry from the retail-driven volatility that defined previous bull runs. In the latest video from Crypto Wendy, she sits down with Adam, the CEO of Blank Square, to talk about a side of crypto that often gets overlooked: true privacy. Adam explains that while many people think crypto is anonymous, most transactions are public. His project, Blank Square, isn't another privacy coin or a separate app you have to download. Instead, it's a privacy tool that can be plugged directly into the wallets people already use, like MetaMask. Their main goal is to partner with existing wallets on EVM-compatible chains. It's my opinion that Blank Square's strategy is refreshingly pragmatic. A lot of privacy projects fail because they try to build their own isolated ecosystem and convince everyone to move over. That's a huge ask. By creating a tool that integrates into existing wallets, they're meeting users and developers where they are. The idea of offering wallets a revenue share is a very smart incentive. The most interesting part, though, is their shielder guard and retroactive reveal. While hardcore privacy advocates might not like the idea of any backdoor, it shows the team is thinking about the real-world regulatory pressures that big wallet providers face. It's a compromise, but it might just be the kind of compromise needed to get meaningful privacy features adopted by the mainstream instead of staying a niche product. In the latest video from The Modern Investor, the host kicks off by confirming that analysts believe the bull market is in full swing, with wild predictions for Bitcoin reaching $400,000 to $500,000 and Ethereum hitting $8,000 to $10,000. He then looks at a strange announcement from a Canadian firm, Matador Technologies. They plan to raise $900 million Canadian to buy 6,000 Bitcoin by 2027, which they confusingly claim is 1% of Bitcoin's total supply. The host immediately calls out the math, noting that 1% is actually 210,000 Bitcoin, not 6,000, making the company's entire plan seem questionable. The video brings up a recurring theme in the crypto world: the battle between corporate narratives and on-chain reality. The confusion around Matador Technologies' math and the conflicting reports about El Salvador's Bitcoin purchases are perfect examples of how difficult it can be to get a straight story. It seems like El Salvador's government might be playing a public relations game, making defiant statements for the crypto community while telling a different story to its lenders at the IMF. It puts the average person in a tough spot, not knowing what to believe. This skepticism logically extends to the host's points on stablecoins. While major payment companies promote a future of frictionless transactions, it's fair to question the real motives. The concern that these corporate-controlled coins could just be a more efficient way for institutions to monitor and control user funds rather than a genuine step forward for financial freedom is a valid and growing sentiment within the crypto community. In the latest video from the Crypto Jeb channel, Jeb warns that he's turning bearish on Bitcoin for the short term. He believes a drop below $112,000 is not just possible, but highly likely in the next 48 hours. He points out that Bitcoin's recent rally to $115,800 was very weak and failed at a key resistance level. The bigger story, he explains, is that huge institutional players like BlackRock now have a vested interest in preventing a massive blow-off top. They prefer slower, more stable growth with 20 to 40% corrections because it keeps their ETF revenue consistent, unlike a wild bull run followed by a massive bear market that scares investors away. Jeb also shows data from CoinGlass, indicating a large cluster of liquidations for long traders sitting just below the $112,000 mark. He predicts that market makers will likely push the price down to this area to trigger those liquidations. If Bitcoin does break below $112,000, he sees a potential drop to a base case of $107,000 with a worst-case scenario of $100,000 before a strong bounce later in the year. It's my opinion that Jeb's point about institutional players wanting to tame Bitcoin's volatility is a really sharp observation. This idea represents a significant shift from the market cycles of the past. The old crypto narrative was driven by massive, explosive moves. But with giants like BlackRock now in the picture, their business model relies on steady, long-term ETF inflows. A brutal bear market would kill that revenue stream, so it makes perfect business sense for them to prefer a more controlled, steadily rising market. The warning about the liquidation pool just below $112,000 also feels very real. It's a classic crypto market scenario where an obvious support level becomes a trap for over-leveraged traders. It really does seem like the game is maturing, and the Wild West days might be giving way to more strategic plays by the biggest financial firms in the world.